Welcome to the Explainer. You know those squiggly lines on stock charts? The ones that just look like a total mess? Well, today we're going to turn all that chaos into a clear story. So, you look at a chart like this one, and your brain just kind of freezes, right? It feels like you're staring at pure random noise. A lot of people feel that way. It's actually a thing called analysis paralysis. You're just so overwhelmed, you do nothing.
But here's the thing, it's not random at all, not even close. You're actually looking at a story. It's a map of human psychology, fear, greed, excitement, all playing out with real money. And today, we're going to give you the beginner's toolkit to start reading that map.
All right, so here's our game plan. We'll start by decoding those squiggles. Then we'll talk about floors and ceilings in the market. After that, how to follow the smart money. We'll put it all together with a real example and then cover your trading safety net. The goal? To give you confidence and structure. Let's get into it. Okay, let's get right into it. Section 1. Decoding the squiggles. So what's really going on behind that line? Well, every single movement, every little tick up or down is basically a tug of war. It's a battle between the buyers, who are trying to push the price higher, and the sellers, who are trying to cash in.
And that little tug of war is the absolute backbone of something called technical trading. The whole idea rests on one simple, powerful belief. History tends to repeat itself. Why? Well, because the people driving the prices are still driven by the same old things: fear and greed. Those emotions never change.
Okay, moving on. This next part, this is probably the most important tool you'll have in your kit. We're talking about finding the floors and ceilings of the market. In trading, we call this support and resistance.
Let's start with support. Think of it like a price floor. It's a level where a whole bunch of buyers look at the price and think, whoa, that's a good deal, I'm buying. Suddenly, all that buying interest acts like a safety net, stopping the price from falling any further and usually pushing it back up. It's like the market is drawing a line in the sand.
And resistance, well, it's the exact opposite. It's a price ceiling. This is the point where sellers start thinking, okay, this is getting a little pricey, time to sell and lock in my profits. All that selling creates a barrier that the price really struggles to break through.
Okay, pro tip here, and this is a big one. The biggest mistake beginners make is drawing support and resistance as these perfect single lines. But that's not how the market works. The pros think in zones. Why? Because market psychology isn't a single price point down to the penny. It's an area where sentiment starts to change.
And this chart is a perfect example. We're looking at Rocket Pool here. See how the price finds a floor around 25.50? It doesn't just hit one exact number and bounce. It dips into this whole area a few times. That area is the support zone. It's like a little battlefield where the buyers keep showing up to defend their territory. All right, so now we know how to spot a potential floor or ceiling. But how strong is it? Is it a flimsy piece of plywood that's going to break, or is it reinforced concrete? To figure that out, you have to listen for the roar of the market. And that roar is volume.
Here's a simple way to think about it. The price tells you what is happening. It's going up or it's going down. But the volume tells you how much conviction is behind that move. When you see a huge spike in volume, it's like a giant flashing sign that the smart money, we're talking big institutions, is getting involved. That's a big deal.
This table right here is basically your cheat sheet. It's super powerful. Just look at that top row. If the price is going up and the volume is also going up, that is a super bullish signal. It tells you that there's real strength behind the move, that big players are likely buying in. So here's where it all comes together. This is the key. When you find a spot where the price is reacting, say bouncing off a support zone, and at that exact moment the volume surges, boom, that's what we call a high conviction zone. That's the good stuff. It's the difference between just guessing and making a really educated trade. Okay, enough theory. Let's put this all together and see what it looks like in the real world. We're going to walk through a trade example, step by step, using everything we've just learned.
All right, so here's a chart of Filecoin. Step 1, we look for those floors and ceilings. And right away, your eyes should be drawn to that $5 level. See that? It's a super clear support zone. The prices come down to that area again and again, and it's held. So that's step 1. Now, step 2,
we look for confirmation. As the price drops back down to that $5 zone, look at the volume bars at the bottom. Bam! A huge spike in buying volume. This is exactly what we're looking for. You've got the support zone, and you've got the volume surge confirming it. That's an incredibly powerful signal.
Okay, so we've got a potential trade idea, and that's exciting. But wait, hold on. Before we even dream about the profits, we absolutely have to talk about our safety net. We have to talk about risk management. And I'm not kidding. This is maybe the single most important part of being a successful trader.
So how do you build that safety net? With something called a stop loss. Think of it as your automatic eject button. It's a sell order you set up in advance. And where do you put it? The most logical place is just below that support zone we found. That way, if we're wrong, and it happens, and the price breaks that floor, the stop loss gets us out of the trade automatically. It turns a potential disaster into just a small, manageable loss.
And here's another pro rule for you. They aim for what's called a reward-to-risk ratio of at least 2 to 1. What does that mean? It means they won't even enter a trade unless the potential profit is at least twice as big as their potential loss. Why? Because it means you can be wrong more often than you're right and still make money. It's all about making sure your winning trades are much bigger than your losing ones.
All right, we're at the home stretch. So after all this, zones, volume, safety nets, what's the big takeaway? What's the point of all this?
Look, the goal here isn't to get a crystal ball and predict the future. Nobody can do that. The real goal is to trade with confidence and a clear plan. It's about replacing that feeling of fear or just random gambling with structure, so that every time you make a move, you know why you're making it.
So there you have it. You now have the basic tools to stop seeing just squiggles and start reading the actual story of the market. You've got the foundation. The only question left is, what story are you going to uncover first?